The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
Retail sales. I think what's happening to our market, and it's wonderful to have the best week since June, it's wonderful to see the rally continue, is that we've redefined what a pivot is. We've redefined it from meaning lower rates to pausing to slowing. And if you redefine that, then you will have a liquidity effect. And that's what we're getting. We're getting a liquidity effect rather than a fundamental effect.
In other words, we've lowered our standards and we'll take anything at this point, just stop the beatings?
Yeah, and there's reason for that because there is significant value in certain parts of the market. So yes, if you just need a catalyst. The one thing I would caution, you heard from Roger Ferguson earlier today, that this is not because of inflation. Inflation hasn't turned around. Core CPI continues to go up. This is because of financial stability. There's concern that this front loading of rate hikes, and it's massively front loading, will break something in the financial system. So if the Fed does slow, it is because we have financial stability concerns.
That's really bad.
Well, it depends. I mean, if they stop it from getting worse, and if this doesn't harm us and makes us end up in stagflation, it would be good. All I want to say is this is a trilemma. It's not just growth versus inflation. It's growth, inflation, and financial stability. And somehow the Fed has to find its way through this, as does the ECB, as does the Bank of England.
The UK, let's talk about Japan, because there's some really interesting things in the Confucian sense of things.
Japan is a different issue. Keep an eye on Japan. It is a potential source of systemic risk. Look, when you fix any price against what's happening in the global economy, in this case it's yield, it's the yield curve control, you have tensions building, and you've shown the currency. There's been massive intervention. The Japanese bond market hasn't functioned properly for weeks. So they're going to have to exit YCC. And the marketplace right now is saying anything that happens in Japan stays in Japan. Let's hope so. But the UK reminded us that cross-holdings of assets can create contagion.
So, Mohamed, you're basically saying there's still a lot of big concerns out there. Don't get too excited by this pivot because we've changed our definition so many times. You're not buying it just yet?
So I'm saying if you're a tactical investor, we probably overshot and you have some scope here. If you're a long-term investor, focus on the few names you know well and have a massive appetite for more mark-to-market risk. Because once you go outside the US, there are still a few issues that haven't been resolved, and they speak to spillovers for us.
Does this little rally make sense to you? I mean, some people think that this is the beginning of something. Some people think this is a grand head fake.
I think Joe summarized it very well. This is a market that repeatedly falls in love with liquidity and therefore rallies, but the sustainability of those rallies is only there if you get fundamentals improving. That is the lesson of the last 2.5 years. Now, when you're in that rally, it's incredibly powerful, it's incredibly rewarding, but then you get the fundamentals.
Right.
So looking forward, and I am among the people who don't know, looking forward, the question is, when will fundamentals validate a liquidity rally? And that's the big question. So far, fundamentals haven't validated it, and that's why people are worried that we're going to test the lows.
Part of the reason that the market has done so well this month, at least in the last week or so, has been this idea that the Fed was going to slow down.
Look, I think the challenge has been that the market, which is meant to be forward-looking, also has built in a kind of optimism, and I think it's disconnected from the Fed's deep commitment to getting inflation much closer to the 2% target. I think the market also has been, hanging on ideas, first peak inflation, then pivot, and losing track of the big picture, which is that inflation is dramatically higher than the Fed likes. Labor markets are still very tight. Survey data suggests that the CEOs plan to increase wages going forward for some period of time. And then the article that Nick just wrote suggesting that households are actually in pretty good shape when it comes to cash. All of these things, I think, will be driving the Fed to keep rates higher than maybe the market expects and for longer. And so I think that's been the disconnect. And frankly, it's to me a bit of a head scratcher. So overall, I was a little surprised at the strength of the market in October because I don't think it reflects what's likely to happen in interest rates going forward for the next maybe even year or so before the Fed actually starts to reduce rates.
So even if the CPI number cools by 0.1%, that's not enough because you need to see significant cooling?
It's certainly not enough. And I think we've heard Chair Powell talk about it. I think he used the word clear and convincing evidence. You know, he's a lawyer by training. Those words carry a weight. And so I think the market is hanging on straws of hope that, oh, it's the Fed's job is done. I think the Fed is not going to react to, straws in the wind. I think they want to see very concrete evidence of a clear downward trajectory in inflation. 1/10 of a point here or there is not the same as clear evidence of a downward trajectory on inflation.